The broadcast is now starting. All attendees are in listen-only mode.
Hello everyone and welcome to the Pensionmark webinar featuring JP Morgan and First Quarter's Guide to the Markets and Economy. We appreciate all of you taking the time to join us today. A few items to go over before we get started. First, in order to ensure everyone has the ability to hear the information presented by our guest speaker, everyone will be on mute during the webinar. Second, please feel free to write in any questions you have using the Q&A tool on the webinar menu. And at the end, we will take some time to go through these. And now I'd like to introduce our guest speaker of JP Morgan, Jack Montague. Jack is a Vice President and Client Advisor with JP Morgan Asset Management. In his role, Jack is responsible for delivering timely market and economic insights to financial advisors and their clients, as well as consulting them around the depth and breadth of JP Morgan's investment solutions. He has served over 10 years in the financial industry and is responsible for the Los Angeles and Mid-Coast region with JP Morgan. Jack is an avid golfer and recently became the father of his first child, Patrick. Jack and his wife, Kelly, currently live in Culver City, California. And with that, I'll go ahead and turn it over to you, Jack.
Thanks, Tori. I appreciate you having me on the call today. So what I'd like to do today is a number of things. One, I'm going to share with you a little bit about JP Morgan and why we're on the call this morning as a strategic partner to Pensionmark. And then we're going to jump right into our Guide to the Markets update in terms of what we're seeing for the first quarter of 2015 and the remainder of this year. There is a lot of information, so we are going to dive right into it and show you the nitty-gritty nuts and bolts of the economic data. So at the end, we'll be able to do any questions or address any specific concerns that you have, but we are going to be running through roughly 20 slides of global economic data today. So we're not going to mince words. We're going to give you everything that you could possibly want in terms of a data standpoint to make the best decisions and help you build stronger portfolios and invest with confidence for 2015. So why is JP Morgan here? Obviously, JP Morgan is one of the most respected institutions in the world. We've been serving high net worth individuals, financial consultants, and individual investors for over 100 years. And really, the strength of JP Morgan comes down to our people. We have over 900 investment professionals located in over 35 countries, and we consider them to be the best and the brightest in the world. You know, we have over 50 4- and 5-star rated funds by Morningstar, which is important just to show the depth and the breadth of our products, which allows us to be more consultative and discuss what we see from a capital market perspective. We don't ever have to say this is the best or worst place to be. It's up for you to decipher the information and make do with what you will. So what we're going to do today is really go through part of JP Morgan's intellectual capital and really the strength of our resource, which is our Guide to the Markets quarterly guidebook. Now, this is a tool used by financial professionals, institutions, and investors alike that is printed over 100,000 times every single quarter in 7 languages around the world. It is by far the most commonly used tool amongst financial professionals, which is what we're going to show you today. So again, not going to cut through any of the details and spare no detail. So there are 4 themes that I want to talk about here today. The first theme I want to talk about is how oil prices shape our view on the overall economy. Second, I want to talk about wages, unemployment, and inflation and what they mean for interest rates. The third thing I'm going to discuss is the investment implications of a rising dollar. And finally, we can discuss the risks and opportunities and the need for balance in portfolios for the year ahead. So currently, we're in the 6th year of an expansion and are likely closer to the end than we are to the start at this point. This is not the longest expansion in history, nor has it been the most impressive bull market, but we've seen the unemployment rate decrease sharply, and despite this, there are still investment opportunities in risk assets that we do like, which we're going to dive into. So let's take a look at page 28 first. This is the Guide to the Market slide that addresses many questions that investors have about oil. And right out of the gate, you know, why did oil prices collapse? The left-hand side of page 28 shows that oil production has increased by 2.9% from 2013 to 2015. and the U.S. is almost exclusively responsible for this increase in production. The European and the Japanese consumption numbers have been weak of late. In addition, OPEC decided not to cut production quotas because it is not unified enough to make such decisions at this point. So what does the excess production and the weakening of consumption say? It's really responsible for the drop in oil prices because oil is strictly a supply and demand market function. So higher supply means, that we don't have to have such high prices going forward, which is why we've seen the north of 50% drop year over year in oil. So where do oil prices go from here? As long as the global economy is growing, oil prices are going to recover, hopefully. In the long run, there's been a big supply and demand response, so prices tend to stabilize in the long term. And because of lower oil prices, people tend to consume more while companies produce less. There was rarely an immediate supply and demand response to oil prices, but eventually prices should balance out over the course of this year. This is evident on the chart on the right-hand side of the page 28 when oil prices dropped sharply in 2009. One of the best examples here is, when oil in 2008, 2009 was trading at 120, 130. It wasn't a real sign that the economy was on the strongest footing, as we know, because markets went through the Great Recession shortly after that time period. So having oil lower today is not necessarily a significant indicator that the economy as a whole is in a weak position. It just means that oil prices are lower due to those supply and demand functions. So if we move forward to page 29, we can actually see the page of the guide that addresses what all this means for the global economy. Now, despite volatility, which is a natural cause of that, lower oil prices are an overall positive. The right-hand chart of page 29 demonstrates that Canada and Russia are negatively impacted by low oil prices, as they are smaller oil-producing countries. As for the U.S., it actually imported 1.6 of its oil in 2013, which makes us a net importer, which means that we should benefit from lower oil prices today. France and Germany, Japan and China are all big beneficiaries of lower oil prices. Thus, lower oil prices in these countries will push up consumer demand and consumer incomes, which is a very healthy benefit. In the U.S., lower oil prices can hurt capital spending, but also act as a transfer of wealth from corporations to consumers. This recovery has been going on for 6 years now, but it hasn't necessarily been felt by the lower income middle wage earners of the U.S. Population. So when you have lower oil prices, they're not spending as much money at the pump each and every week, which means that they have more discretionary income, which means they go out to an extra dinner with the family. Maybe they buy some new toys for the kids. Maybe they go on a new road trip. So lower oil prices is essentially a tax cut for the average consumer in the U.S. And overall, lower oil prices act as roughly a $100 billion tax cut for the U.S. economy. So very good positives coming out of lower oil prices. So let's move forward. Let's talk about page 16 of the guide, which shows the economic growth and the composition of our gross domestic product. So why is consumer spending so important? Well, we just covered that. The right-hand chart of slide 16 shows that consumer spending makes up roughly 68% of GDP in the United States. So in 2015, we expect capital spending, housing, and net exports to grow, but the major improvement will be in consumer spending. We expect consumer spending to grow at more than 3% annualized in 2015, which will bring us to roughly 3% GDP growth in 2015 as well, slightly higher than we saw in 2014. So the biggest impact of lower oil prices will be consumer spending, thus boosting the economy. And 2015 is shaping up to be better than 2014 from the overall economic outlook standpoint. So when you're talking about economic outlook, you have to talk about inflation, which is on page 26 of the guide. The November CPI reading came in at 1.3% year over year and 1.7% on the core inflation numbers. So we expect inflation to read 0% by the time the January CPI report comes out, which is largely due to the decline in oil prices. However, we do expect core inflation to nudge up to around 1.8% year over year. So as oil begins to rebound, we are likely going to see better inflation numbers on a year-over-year basis. Oil prices are not fundamentally deflationary and, in fact, actually add to consumer demand. So it is likely that by the middle of 2016, headline CPI will actually surpass core inflation, and both will have moved up nicely together. So if the Fed is actually correct in their thinking that this disinflationary effects of lower oil price are really transitory and are not going to have big impacts long-term on the U.S. economy. Now, things that will have a big impact on the U.S. economy are the labor market perspectives on page 24. Page 24 actually will show you a graphical depiction of the growth in payroll unemployment as well as the drop in labor force participation rate here in the United States. So the Fed may be underestimating how tight the labor market is today, and the chart on the bottom right shows the ratio of number of employed people to the number of job openings, which is at its tightest level since mid-2000. So there's actually a high demand for labor right now, which is a good thing because people have been taking jobs over the past 6 years that were really below their education level and the standards of their tenure within their industry because they just wanted to have any job as opposed to being unemployment waiting for their dream job to roll back around. So as the labor force tightens, you're actually going to see a lot of people voluntarily be quitting their job and being able to access those higher wage and higher earning potential jobs which befit their skill set. So a very good positive in terms of the labor market, what we're seeing from the numbers there. Page 23, moving on, will actually show the unemployment and wages and how they actually move together. So we do believe it's an important thing to recognize at this stage that unemployment has fallen significantly. We've seen it come down from roughly 10% in October of 2009 to 5.8% at the end of the year 2014. So the jobs report on January 9th shows that unemployment has actually ticked down to roughly 5.6%, which is an extremely healthy number in the U.S., slightly below the 50-year average at 6.1%. So if you look at the relationship between wage growth and unemployment for the past 30 years, there has actually been a negative correlation between the two. So when unemployment comes down, wage growth will increase. And we do believe that negative correlation exists today, as we mentioned on the last slide. So wage growth has been slow to pick up, mainly because people didn't realize we were in the midst of an economic expansion. And now that sentiment is changing and consumer confidence is picking up, we may see some wage growth increases in 2015, which is again a very strong positive. So we've talked a lot about the Fed and their expectations and some of the areas that we believe they've gotten it right and wrong. We've actually got a great chart, which is one of the more commonly used on page 32, which actually addresses the Fed and their interest rate expectations. So let's just shoot to the bottom right-hand chart on page 32, which will actually show the Fed's forecast from their December meeting. So the Fed is predicting a 2.4% GDP growth rate in 2014 and a 2.8% GDP growth rate in 2015 and 2016. That's roughly a 20% jump year over year in growth in the United States. So the Fed is also predicting that the unemployment rate will come down about 0.5% between the fourth quarter of 2014 and the fourth quarter of 2015, dropping from 5.8 at the end of 2014 to 5.3% at the end of 2015. So we believe that the unemployment rate is actually going to be lower than the Fed is forecasting. We believe it to be inaccurate by the fact that the Fed is just misunderstanding the labor market dynamics in the charts that we showed earlier. So we do believe that the unemployment will be at 5% or lower by the end of 2015, and in 2016 it could even be in the high 4s. So we just expect that the Fed is behind the game right now. With their estimation of 4 rate hikes in 2015 on the short end of the curve and 5.5 rate hikes in 2016, four rate hikes in 2015 is just not justified in this economy. We actually believe that we're going to get 6 to 8 hikes in 2016 and about the same in 2017. So you can see on that bottom right-hand chart, the federal funds forecast. They called for 0.13 at the end of last year. That's fine. That was in the 0 to 25 basis point window that we've been in for the past several years. And at the end of 2015, up to 1.13, and then up to 2.50 in 2016. So what does this really mean for the bond market, right? I mean, interest rates are the biggest indicator for returns in bonds, and the 2-year yield is already increasing, but we do not see a long-term rates rising that much. So if we see even a 50 basis point increase along the long-term Treasury bond, it would actually wipe out the coupon for that year, giving you a negative returning fixed income. So we do believe that investors should be underweight fixed income in 2015 and very selective in the bonds that they're actually purchasing for this year as well, if they are going to be having access to that. So let's take a look at some of the bonds. Let's take a look at page 39. Page 39 will actually discuss the high yield bond market, which is one of the biggest areas of interest for 2014 and 2015. And it actually shows that the high yield areas did not produce stellar returns in 2014. This was because of a backup at the end of the year, largely due to energy high yield. Energy actually accounts for 17% of the high yield index in the U.S., and as we know, there was a big sell-off in energy prices, which negatively impacted the performance attribution for the high yield markets because of that allocation to energy within their index. So outside of energy, we do believe that defaults are going to be very low, and with plenty of cash on the sidelines ready to go into high yield does look attractive to us outside of the energy sectors. In European high yield, you can actually see the relationship on the bottom right-hand chart. There's actually no exposure to energy. So there could be an opportunity within the high yield markets outside of the United States today, which would be an area of interest for us. So overall for 2015, high yield is one place to look at for fixed income, and we would recommend taking a look outside of our borders for this year. Other areas of the fixed income market that could be potentially beneficial for 2015 is actually on page 40, which talks about emerging market debt. We don't have to spend a lot of time on this slide, but page 40 does show sovereign yields and their spread to treasuries over a 5-year maturity. So particularly in Brazil, for example, you can make 10% higher than the U.S. Treasury. And Brazil is not likely going to default in the next 5 years. So if investors just hold their bonds until maturity, they can get 10% more returns in terms of the income stream that they're getting as opposed to buying a traditional U.S. Treasury bond. So there's obviously some credit risk in some countries, but overall there is opportunity in emerging market debt as an alternative to fixed income where, the Fed has told us they're going to be rising the short-term rates overseas, as we've seen from the European quantitative easing measures that they've just announced, as well as some of the benefactors of emerging markets. Rates may actually be falling, therefore creating opportunities outside of our borders. Let's transition now to the equity side of the outlook for 2015. On page 8 of the Guide to the Markets, you're actually going to see corporate profits and leverage. This is a great slide that shows how we've been slowly recovering in the U.S. On the left-hand chart. Earnings have been growing significantly since 2009, and we do expect the next earnings season to be above $30 a share, with even higher dollar and lower oil prices, which are all going to be benefactors to U.S. companies. So we expect to see strong earnings and good gains in the U.S. We're actually going to have roughly 170 companies within the S&P 500 report earnings this week, so we should have some better data at the end of the week, but so far things are looking quite strong. Moving forward, there's the lower than expected interest rates at the start of this year will also help corporations, and wages will go up as the year progresses. So we believe that we will have a mid-single digit year in earnings gains. The profit margins came in at the end of 2014 in the top right chart between 10.1%. That's a great number. It's actually an all-time high in terms of profit margins. We expect companies to continue to trend higher, but with higher wage growth and people demanding higher incomes, that will obviously nip into the profit margins of the companies in the United States, bringing those numbers slightly lower. But if you demand higher wages, that generally means you're going to be more productive within the role, so you're actually going to produce more output for your company, therefore continuing to increase profit margins overall as well. Let's look at the valuation measures. There's been a lot of concern on page 7 about where the S&P is trading because we are above average in terms of our historical or long-term averages. You can see the price to earnings on page 7. The latest reading is 16.2, which is above the 25-year average of 15.6, but still not very expensive compared to where we have seen the S&P 500 forward PE ratio compared to history. If you just look at the bottom left-hand chart, you can go back to the mid-90s, early 2000s, where we were trading at much higher levels relative to the current 16.2. So the stock market will probably rise this year unless we get hit by a huge shock to the system, which we cannot predict, the black swan or the geopolitical events that may take place this year. And with few alternatives to fixed income or cash, the stock market appears to be a really good option as most companies within the blue chip realm continue to grow their earnings, as we mentioned, as well as return capital to shareholders in the form of nice dividend income streams. So it is still important to remember that as interest rates normalize and stocks get more expensive, we may have only gains in the mid-single digits, but we'll take that as opposed to a negative market. So rising confidence is probably going to cause multiple expansion, and it has done that in the past. And the bottom right-hand chart shows the S&P 500 earnings yield versus a similar bond AA bond yield. You can see that the earnings yield on the S&P 500 is 6.2 versus the bond AA yield at 4.7, hence making stocks relatively more attractive than a bond invested today by roughly 1.5%. And we're going to monitor that as those spreads do narrow. But for right now, equities still seem to be the stronger risk-adjusted returns of the two relative to fixed income. So page 6 can address a really good question for you. Page 6 will actually show the returns and valuations by sector. And this can answer the question, what am I looking for? So the answer usually revolves around the rising market, which means you want to have a reasonably high beta to the S&P 500. You're also going to need to have a positive correlation to Treasury yields. So it's a very small line on here. It's roughly 5 or 6 down correlation to Treasury yields. This is a number that we look at JP Morgan, which essentially shows the relationship between rising interest rates, which we expect the Fed to rise this year, and the stock price appreciation upward along with it. So you want to have a high correlation to rising rates, so your stock price will rise up along with it. So areas that we do like would be financials, which have a 0.02 correlation to the positive, as well as industrials, which have a 0.17. Areas that you're going to want to avoid would be sectors like utilities and telecom, which have a negative 0.21 and negative 0.5 correlation respectively. So while they may have done well this past year, they will likely not do very well in a rising rate environment, which we expect to be the future. So you want to be nimble. Things that worked last year are not going to be the same things that worked going forward. We do also believe that consumer discretionary, technology, and financials will do well with their higher earnings growth as well. So this is the type of environment where you need to select sectors that will not get hurt by a rising rate, but will also benefit from a global economy. Very simply put, all sectors within the equity markets are not created equal at this point. Correlation between equities have been falling quite significantly over the past 3 years. So we would recommend really doing your due diligence, really kicking the tires, and buying the highest quality companies with good cash flows, good earnings capabilities, and strong management that are going to be able to weather the changing dynamics and landscapes of the global economy. So we can take a quick look at the long-term drivers of economic growth and why we do see output increasing. Page 21 of the guide will actually demonstrate several things that we want to cover here. So the right-hand chart of page 21 will actually show that over the past 50 years, the U.S. has managed roughly 3% in real GDP growth. It's a great number. This has come from roughly 1.5% growth in unemployment and 1.5% growth in output per worker. However, in the past 10 years, output per worker has only grown by 1.1%, and it will likely stay around this level going forward. So also in this is that in the last 5 years, we've seen 1.1% growth in unemployment, most of which has come from falling unemployment in the U.S. So only 0.2 to 0.3% has come from an increase in labor force. Thus, if the employment gets down to 4.5% by the end of 2016, it really isn't likely to fall much further than that. And if the economy doesn't slow down at some point, it is going to hit a wall at the end of 2016, in which case we're going to have to change some of our capital market assumptions. The only way out of this will be massive immigration reform to increase the labor supply. Otherwise, we're going to slow down in terms of our growth forecast after 2016. But that is yet to be determined. Some question marks revolved around the long-term drivers and what's going to happen coming out of Washington. Let's take a look at the global equity markets going forward on page 42. Page 42 shows how 2014 was a good year for the U.S., but a bad year for international investing. This was largely due to a stronger dollar, and the IEFA index in developed countries shows that returns denominated in local currencies were actually positive, but the returns for the U.S. dollar were actually far below that, and in some cases negative for the international markets. We do really like international investing as an area of opportunity for 2015 and 16. You can actually see on the top right-hand chart of this slide on page 42, the percent of global market caps that is located in the U.S. is roughly 51% today. But that means that 49% of the global market cap companies, or the opportunity set that exists today, is actually outside of our borders. So if you are strictly only investing in U.S. companies, you are only investing in roughly half of the opportunity set that is available to you today. So we do like blue chip, multinational, dividend-paying stocks that are domiciled outside of our borders, because you will find some real healthy dividends and strong growth components there going forward. So let's transition even further. Moving on, let's cover the trade in the U.S. dollar on page 27. Page 27 of the guide will actually show how the dollar is at its highest level since the early 2000s. This poses the question, where does the dollar go from here? Consensus estimates say that the dollar will continue to rise, but we are skeptical. Since the Fed will probably tighten at least as fast as markets expect, the dollar will continue to have positive forces driving it upward. However, we do believe that Europe will have actually do better than most of the people believe, which is a negative for the U.S. dollar as well. So question marks around here. The left-hand chart shows that the U.S. actually still has a trade deficit, and if we don't enact, again, immigration reform, tax reform, and get capital spending and the labor force growing, the U.S. will grow more slowly in the future, and at the end of 2016, the U.S. is going to be a much less attractive place than it was at the end of 2014, as we mentioned earlier. Now, if this is the case, the dollar may not continue to rise, but the dollar should not dissuade investors from capturing opportunities in the international markets. So this is a long way of saying that the dollar has done very well in 2014, roughly appreciated up 10 to 12% on a weight-traded basis compared to other global currencies, and we do expect that trend to continue as we see strong, economic data out of the U.S. in 2015, but to a lesser degree, and then at the end of 2016, depending on where we are with our immigration and tax reforms, things may start to change and turn around. So we've mentioned a lot about Europe. Let's take a look at page 47. Page 47 will actually talk about the cyclical headwinds and tailwinds and where we see the story in Europe heading. So sovereign debt yields have come down. Austerity has diminished. Europe will benefit from a lower euro as they begin to pump more money into the system in their bond purchase programs through the new $1 trillion QE that they've just launched to the tune of $60 billion euros purchases each month starting in March going to September of next year, which helps European markets because they're generally export-driven at this time. They also import a lot of oil, more so than the U.S., which will help the Europe's economy because oil prices are lower. And the stress tests that have been done on the financial system overseas are now completed and over, so banks don't have to hold so much money on the sidelines. They can begin to invest and take a little bit more risk in their balance sheets. So overall, employment across the Eurozone is still at 11.5%. So Europe has a lot of room to grow. They are going through some major structural and reform mandates today. But we do think overall they're going to get their act together. It is a very attractive from a valuation standpoint, and we are going to take a look at the valuations on page 54, which will show global equity valuations in developed markets. So we can actually see the composite valuation index, which looks at price to book, price to cash flow, and dividend yields. And we can see, as we mentioned earlier, the U.S. is the most expensive market among developed countries. The dividend yield is at its lowest in the U.S., with the exception of Japan. And because of the valuations and long-term growth prospects, people should look outside the U.S. for long-term investing opportunities because, again, we do think that they're attractive from a valuation standpoint, and the companies that make up the Eurozone are in great condition. This is an instance where we have to separate global headlines in terms of economic data from the earnings potential of the underlying companies within specific countries in the Eurozone where we can find opportunities. We do recommend active management through mutual funds or investments managed by professionals in these areas because there's a lot of moving parts and a lot of things that can derail growth overseas, and you want to be flexible and nimble enough to move as tides move with them. So let's take a look quickly at demographics as well overseas. This is a story really for the emerging markets side of the coin. If you take a look at the demographic growth and the impact of urbanization, you really have a great long-term story as emerging markets begin to spend money on infrastructure projects to move the mass amount of populations that they have into more urbanized areas to give them better water, better railroads, better transportation, LED lights in the railroads, roadways, to allow them to move into more city areas, therefore taking on better earning wage jobs, and then of course that would give them more discretionary income, which means they could spend more back into the global economy. So an area like India is a great area that we're looking at right now, because roughly 38% of the population is under the age of 20 today. They spend roughly 35% of GDP on investment, similar to Mexico, which shows the growth potential as their population begins to age, as they begin to get more educated, and again, if they begin to accept higher earning jobs, in which case they're going to demand things that the U.S. consumers have the luxuries of having, whether it's a new cell phone, a new car, a new iPad. They're going to want to up their quality of life as they begin to earn more money down the road. And again, that's going to have a big impact on their spending ability, which should help the long-term drivers of growth in the emerging market countries. Slide 55 will actually show the relationship between global equity valuations versus emerging markets. So you can actually see here how emerging market stocks are now trading at a cheaper value by actually one full standard deviation compared to the ACWI index. So the ones we like best are India and Mexico, and not surprisingly the most expensive because they are attractive. So people need exposure to emerging markets in the long run. It is a significant opportunity set. You just don't want to limit yourself to developed markets. You want to have a long-term play within emerging markets as we continue to see them improve in their quality of life. So in summary, we're going to take a look at just page 56, which is the overall asset allocation. The year in 2014 was overall a good year. Our asset allocation did 5.2%, while the S&P 500 and the Barclays Ag did higher than that. Commodities dragged and international stocks were hurt by a rising dollar. In 2015, some of the risks will include a Greek exit from the Eurozone. There's some questions around Vladimir Putin and Russia and the debt problem in Japan and China. Nevertheless, there is still a lot of potential. The global economy is still growing despite low oil prices, and it's still time to be overweight risk assets, but investors really need to be more selective about the sectors, the countries, and the instruments that they're using, because things are just no longer as cheap as they once were, and it's really more difficult to find value in today's markets. So people need to be diversified going into the new year and take advantage of all the opportunities in the U.S. and around the world. So that's really the end of my formal comments. If we can, Tari, we'd like to just open it up and see if there's any questions from the field.
Absolutely. Thank you, Jack. We appreciate you sharing your time and knowledge with all of us here today. And as you mentioned, we're going to go ahead and start addressing some of the questions that have been filtering in. Just as a reminder, if you have any questions, you can submit them using the Q&A tool on the webinar menu. And as always, you can reach out to your dedicated service team at Pensionmark for any plan-specific questions you may have. Our first question for Jack, you mentioned wages being increased. What is the cause of this specifically?
So wages increasing comes from the tightening in the labor force. So we mentioned earlier that the unemployment rate had dropped from roughly 10% down to the 5.8 number today. So as you have a lower level of the population unemployed in the United States, it becomes harder for employers to find people to fill the jobs that they have open on their docket. So when you have a lower supply set of people that you may want to hire, in order to compete for those people to come in and fill your jobs, you're going to have to start to pay up in the terms of wages to attract the highest quality employees to come work for your job. When you have high unemployment, you don't have to pay people as much as they expect because you have 10 other people that are willing to take that job at any cost and really at any income level. So with the unemployment rate coming down significantly by about half in the past 6 years, the tightening of that labor force is really going to drive wages higher because, again, people can demand those in this environment today.
Thank you, Jack. Our next question, how much will the Greece elections affect the international market and, in consequence, affect the U.S. market?
So that's a great question. That's been one of the biggest areas of concern. So going forward, there's a lot of actual voices that have been made public on this topic, whether Greece is finally going to disembark from the Eurozone and go back to one of its individual parliamentary governments. It's not in our expectation that the Greeks are going to do that, but within the quantitative easing measures that Mario Draghi and Angela Merkel have just launched overseas, one of the major things that we are looking at is the amount of spending within that $60 billion euros that they are purchasing every single month, where that is going to be deployed to. One of the question marks that is unforeseen right now is, are they going to buy German public debt, or are they going to buy Greek private debt, and vice versa? So the deployment of the amount of assets that they're purchasing within this quantitative easing measure is really going to be a big driver to see if they can sustain the stability of that region and what it looks like going forward. So there is no direct answer. The elections were a positive overall, but we don't see that the, call it, next 6 months is going to hold anything in terms of Greek leaving the Eurozone at this time because of the steps that the central bankers overseas are taking to support the region as a whole. That one's going to be something that we're going to have to watch over time and see if it plays out for the better or for the worse, unfortunately.
Thank you, Jack. Looks like we have one more question. If the Russia economy collapses, how would it impact global financial market?
That's a tougher question because Russia would be a much larger portion of global GDP when compared to the Greeks. If you were to take a look at a scenario in which case you would have Greece actually dissent from the Eurozone, the Greek GDP within the Eurozone would be the equivalent on a U.S. basis if Rhode Island was to leave the United States. It's a very small portion of overall growth that makes up the Greek debt compared to the overall region. Now, within the Russian markets, that is a much larger percentage of global GDP and global earnings. So the Russians have had a really tough time in dealing with some of the, call it, political ambitions that Vladimir Putin and the Nationalistic Party have taken upon themselves with this Ukrainian situation, because the ruble has fallen significantly. And there's become a lot of dissent around Vladimir Putin and his agenda, and whether or not he's going to be able to turn the tables and get the Russian economy back up to par, if you will. We don't believe that the Russian economy is going to collapse per se. They do have enough money within their coffers to support themselves internally, but it does not mean that the assets and investments within the Russian markets are a place that we find attractive or a place that you should be doubling down today. So it's unlikely, again, that the entire economy will collapse. It will have significant burdens on the global economy if that was to be the case, but at this time we are not forecasting that to be a part of our agenda or some of our major concerns for 2002.
Thank you, Jack. It appears that there are no more questions at this time, so this will conclude this webinar session. Thank you again, Jack, and thank you, attendees, for your participation. I hope everyone has a great day, and we look forward to our next webinar series with you. Take care.
Thank you. Have a great day.